Hey guys, before you invest a single dollar in a new city for real estate investing, stop. Don't invest another dollar. Watch this video. Because if you miss one of these red flags we're going to talk about in this video, your deal could go from a profitable deal to a disaster deal overnight. We're going to uncover 8 red flags, big warning signs for you to watch out for when evaluating any real estate market. Now, let's hop in with my business partner, Hervé Francois, who's going to help me unpack these red flags.
It's always a pleasure to be here with you, man.
You and I have learned over the years, man, that you could take a great deal and good funding, good financing, and put that great deal in the wrong market, and it's going to break one of the flags that we're going to talk about today, and that deal will fall apart. The market really is one of the first factors, which is why we're not invested all across the continental United States. We're invested in a few specific markets that meet the parameters that we talk about today.
You cannot out-invest a bad market. You cannot out-underwrite, if you will, a bad market. No matter how attractive the rent growth, your value add, turnaround play is, and so on and so forth. If this market is slowing down, if it's deteriorating, if it's not good from the jump, it is not going to work out for you, and you're going to wind up being in a world of mess. And we don't want you to get into that world of mess.
Let's jump into red flag number 1. Obvious one, guys. That number 1 is population.
Now, we are looking for steady population growth year over year. It doesn't have to be population growth of 8 to 10% per year and so on and so forth, but we're looking for steady Eddie 2 to 3% population growth. Some of that is going to be driven organically, the people within the state. Some of it, and a lot of it over the past several years, is going to be due to migration trends. People leaving one state, one city, one market, going into a new city or a new state. All of that is predicated upon perhaps someone leaving a high cost living area, going to a lower cost living area. Their job, their company is moving from where they were living to now this new low cost living place. Are people moving in here? Does the city have steady population growth? We're not going to be attracted to a city in which the population is either aging or there is out migration. That city is losing folks, again, because it's too high cost of living. The jobs are moving out, shifts in the marketplace, and so on and so forth.
Good, steady growth that's not spiking growth. Look at cities like Austin, Texas. Good, hot, sexy market that a lot of people were investing in, but it overgrew. Population's increasing quite a bit, but you can't sustain a huge population growth like that. So it's going to level out. It might even decline a little bit. Good, steady population growth means good economic growth.
Growth equals demand, and demand equals risk. And that's why we want to focus, we want to target on growth. You want those kind of trends, the growth trends, the positive migration trends, to help your underwriting, to help your decision making on where am I going to invest. Real estate investing is fun, but it can be difficult. Don't make it more difficult on yourself because you chose the wrong market.
So moving on to number 2, Hervé, jobs drive everything, but jobs are not everything. And there are certain traps that people can fall into, one very specific one when it comes to jobs in a market.
A city with one major industry is challenging. It's dangerous, right? If that particular company leaves or if that industry leaves, that city's going to take a major, major hit. As we know, a lot of industries out there in this country, they're very, very cyclical. They go through boom and bust cycles, right? But in that bust cycle, you're probably still holding on to your property. But what happens to a property during a bust cycle, right? You wind up losing tenants because the tenants wind up losing their jobs, or the tenants wind up having to take on lower income. They can't afford your rent. All of a sudden, your occupancy starts to decline, vacancy starts to increase. But what happens? You probably have fixed rate debt, God forbid, variable rate on your property. You still need to maintain those monthly mortgage payments. You still need to pay the workers working on your properties and all the other expenses. So you want to smooth out being in a city that has aggressive boom and bust cycles by being in a city that has an economy driven by multiple industries and not just one.
Look back to the Rust Belt that were driven 100% by the steel industry. They did come back, but it took them a long time to come back when a lot of that steel production moved overseas.
Absolutely.
Moving on to the third red flag, Hervé. Let's talk about cranes in the sky.
Right.
But that's not always good news. I did a fix and flip in South Philly many years ago. And I was like, man, look at all this housing production. Look at all these other people doing fix and flips in this market. And then when I put my fix and flip on the market, all those other fix and flip became my competitors.
So cranes in the sky, right? That took this huge supply of more and more units, more and more apartment buildings going on. Now, listen, that could be predicated upon there's a lot of population, there's a lot of people moving into that particular city, that there's a lot of jobs moving into that particular city. But developers, sometimes they have a hard time seeing through the forest. They hear about increasing in population and job growth. Let's build, 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 build. And all of a sudden, you fall for that particular trap. Now, all of a sudden, you're purchasing one of those properties in a city, in a market that is seeing a lot of incoming supply. You talked about Austin, Texas. You talked about Phoenix, Arizona. Those are perfect examples of cities in the Sunbelt market over the past couple of years, Matt, that have seen a lot of downward pressure on rents because so much supply has come into those cities. Yes, those cities are benefiting from some good job growth, but it was way too much oversupply, so much so now those cities over the past couple of years experiencing rent declines of anywhere between 4 to 5, sometimes 5 to 10%, depending on that particular city. Very hard for you to execute on your business model. I don't care if it's a Class A property or Class C property. Very hard to execute.
Overbuilding can start to drive concessions, which is going to drive the entire market down, meaning like those builders, when they're done building their buildings, they need to be fully leased or they're going to lose those properties back to the bank. So they're going to start dropping their rents and that's going to pull everything down. Watch those cranes in the sky. Moving on, this one gets missed a lot. Fundamentals, the baseline, the bottom of the pyramid, right?
Yep. The fundamentals are the basics, right? I mean, you talk about the fundamentals of an athlete, right? Just starting with the basics and, properly holding on to that football or basketball before throwing it or shooting or something like that. But in our world, when rent growth outpaces income growth, affordability just crashes. If the tenants can't afford the rents, that leads to evictions. Again, like you were saying before, high concessions and negative absorption. It's almost like if you will, what a child goes through when they're eating candy, a short-term sugar high, but very long-term unsustainable. Remember, you're buying these properties, you're buying them for 3, 5, 7, 10-year holds and things like that, right? So you don't want to be in a market where that rent growth is outpacing the income growth, right? You need to have your tenants, their income continue to increase. Otherwise, you're not going to be able to go ahead and afford that higher rent. It's one of the reasons why a lot of landlords, they have that rule of thumb where they want their tenants' income to be at least 3 times monthly rent. If you're in a market that has been experiencing very high rent growth, you may want your tenants to have even a higher threshold, maybe 4 to 5 times monthly rent, right? Just to make sure that you have a cushion and the tenants have a cushion, because you don't want the entirety of their paycheck going to pay rent because they got so many other expenses they have to deal with on a monthly basis as well.
And a lot of the fundamentals that everybody's talking about here, guys, are covered in the Market Hunter tool. I've got a free tool for you guys. If you guys like free stuff like I do, jump over to DeRosaGroup.com/tools and grab a copy of my business partner, Hervé Francois' free Market Hunter tool. This tool is going to help you score out a market. This score sheet will tell you if a market is a good place to invest or a bad place to invest. And the best part about this sheet is it's got the links of where to go to get the data that it's asking you to use when you score out this sheet. It is a no-brainer scoring sheet. So go to DeRosaGroup.com/tools or go to the description of this video to grab a copy of that Market Hunter tool right now. Moving on, let's go ahead and touch the third rail. Let's talk about politics and the regulatory environments that are there. The red state, blue state thing is BS, okay? We have done business in very, very red states that are very regulatory and very non-landlord friendly. Landlord friendliness does not have to do with where that state swings, red or blue. Unfortunately, it's all over. You got to dig a little bit deeper.
Case in point, state of Georgia, right? Georgia, a red state, but city of Atlanta, right? Biggest city in Georgia that has a lot of population growth, rent growth. Atlanta is an example of a city that does have some rent controls in place, that is a little bit more tenant friendly than the rest of the state, and so on and so forth, right? So if a city has a lot of rent control, if it has hostile zoning laws, endless all kind of permitting delays and landlord-tenant rules, your business model, your underwriting can collapse. It's going to be very challenging. Everything just gets kicked down the road. It's going to take that much longer for you to go ahead and do the renovations on your properties, both external and internal, the zoning rules and everything else like that. Even eviction moratoriums can get extremely challenging. That's going to wind up tying your hands, tenants not paying, but you on a monthly basis still have to make those monthly mortgage payments. The best markets to invest, right, it's stating the obvious, are those cities that are truly business friendly. I'm going to point to cities and states, those cities that are truly business friendly as well as growth oriented, right, that they support landlords coming in either on the development side and or buying and fixing up. At the same time, let's be real, right, and this is where you need to come in, and this is why it's one of the things that we love about DeRosa, transforming lives through real estate, that you still, at the end of the day, this is going to be where somebody lives, where a family lives. So you want to improve, you want to keep the tenants in mind when you're thinking about those improvements. We know that you need to make nice returns to your investors, and you got to make payments to the lenders. We know that, but at the same time, providing your tenants, your residents, a really, really nice, comfortable place to live.
Look deeper into what the actual rules and regulations are, not just for the state, but for the municipality you're considering investing in.
Absolutely.
Moving on, Hervé, to a straightforward one. Let's talk about crime. Nobody wants to invest in neighborhoods that have crime, but how do you break down and analyze crime statistics for a neighborhood or even a region that you're looking at?
Yeah, and you can find a lot of resources, again, on the market analysis tool. We give you some resources, websites where you can take a look at crime data for particular cities and things like that, right? High and or rising crime rates, they really, really tank a neighborhood. It makes it very difficult. Again, you can purchase it right. It could be an attractive price. You can put attractive debt on the property. You have a great business plan, but you cannot out-invest. You cannot outperform a city or a market that is going through difficult crime, high increasing crimes. These folks just not going to want to live there. Again, it's going to cause your occupancy to decline. It's going to cause your rents to decline and so on and so forth. There are things that you could do to improve the safetiness for your tenants when you start talking about LED lighting, security doors, and so on and so forth, even patrolling of officers around the properties, things that we've done to some of our properties in the past. But at the end of the day, you are going to have residents that are going to be hesitant to want to move into your property, not because it's not managed well, but simply because of the location, because it's in a high crime area.
If you're investing in a large enough property and the crime that's in the area is pretty much coming from the property you're buying, that's actually an easy thing to change. Putting more light and attention on the property, getting a partnership with the local police to come out to the property and putting more physical lighting around the property. We've seen that happen overnight to change the crime at a property. Now, if the crime is coming from the local neighborhood, there's very little you can do about that. And so it's really important to know, where is the crime coming from? It's coming from your property. That's actually a good opportunity. If it's coming from the local neighborhood, you cannot control that. Moving on, capital markets and liquidity, Hervé. Let's talk about money.
Yeah.
Let's talk about how money and access to dollars plays into markets to invest in.
At the end of the day, it's very difficult to be acquiring these properties, getting into this business without taking a loan, whether that's going to be from a small bank, or credit union, local bank, or obviously a bigger bank and things like that. So you do want to keep an eye on the capacity that these lenders are putting monies out there in a particular asset class, in a particular city. Banks, as we all know, for them, it's all about risk and reward. And if they feel that the asset class is going to start slowing down, perhaps if the assets are overvalued, if they feel that we're going to start going into an economic downturn, then the lenders are going to pull back. And it's going to be much more difficult for you to acquire your properties unless you're going to do all cash deals. But even still, then you have to worry about, are you going into an economic downturn? So if the cap rates are way higher than the peers, or the transactions are just few and far between, then that's just going to result into the market carrying more risk than reward. And that's not a market that you want to go into at that time.
There are still cities out there that lenders are maybe not fully blackballed on, but maybe a little adverse to markets that are out there. Make sure that there's plenty of lending and lender affinity for the markets that you're considering.
Absolutely.
Bring it home here.
Bring it home.
Historical performance. Red flag number 8. History does tell us a good bit about what the future is going to do.
If a market has boom and bust cycles, you're gambling. You want to really be in markets that hold steady in their downturns, right? They have resilient markets. They're resilient because of the industries that are in there. Again, we spoke before in regards to the economy driven by multiple industries, not any one industry accounting for 20% of that particular economy, and so on and so forth. And again, real estate investing is a lot of fun, but you want the external factors to help your real estate investing, not hurt your real estate investing. And that's why we want to share all of these important red flags with you guys, because if you follow these red flags, if you can at least avoid these red flags truly, then it's going to make your underwriting easier, the investment easier, paying the returns back to your investors, and obviously the loan to your lender. It's going to make it easier, right? You want to walk or run maybe nice little jog with the wind to your back, not the wind at your face. If you avoid these red flags, you'll have the wind at your back. It's going to make real estate investing that much more exciting.
The history does tend to repeat itself. So look for those ripples in the water, for what's happened in the past will likely happen in some sort of an iteration again in that market. Guys, these are the 8 red flags you must watch out for before investing in real estate. If you ignore these red flags, you are gambling. You might win, just like in Las Vegas. You might win on the roulette wheel. You might beat the dealer in blackjack, but the probability is that long-term you will not when you gamble. So pay attention, set yourself up for long-term success.
We want folks to have fun, right? You're committing yourself, whether you're doing real estate on a full-time basis, whether you're doing it on the side. It is hard work. You can have fun, but at the same time, we don't want to make it so challenging. You don't want it to be so challenging because you might have missed one of these red flags. Look at this over and over. Use the tools, use the resources in the market analysis tool. It's going to help you go ahead and do the market analysis even that much quicker, because you're going to have a lot of those resources on your fingertips when you start taking a look at population growth into a market, income growth, crime, rent growth, cap rates, and so on and so forth.
Hey guys, don't forget to go download our free market analysis tool that Hervé developed for you. That's for free, so you guys can determine the good scores, the bad scores of markets, and help you guys stay away from those markets that might break one of the red flags we talked about today. It's the exact checklist we use before ever pulling the trigger on a deal. The link is in the description, so go grab that now for free. By the way, guys, if you guys like what Hervé and I put together here and you like the content we create on this YouTube channel, do yourself a favor, do us a favor, hit like on this video, subscribe to this channel, and share this video with a friend of yours so you can continue to spread the word about the great things we talk about here on this free YouTube channel dedicated to real estate investing and help you guys taking your business to the next level. Thanks for watching, and always, guys, have a great and profitable week.